We have an alarm bell from the chairperson of the market regulator SEBI. She feels some kind of a bubble or at least frothiness is forming in the stock market, especially in the SME segment. The most disturbing part is that SEBI feels there are signs of manipulation in the SME segment, and the regulator has directed the mutual fund houses to conduct a stress test, which I am going to explain in a moment. All this has resulted in a big correction in the small cap index. So today we will try to find out if the small cap stocks are in any real danger. Namaste and welcome to Retail Investing. So let's begin with a scam which probably has some links with all these developments. It's a 6,000 rupee scam happening on a betting platform. There has been a big investigation by the Enforcement Directorate, and it was found that an illegal betting platform was letting people place bets on online games like poker. Betting on traditional sports like cricket and badminton were also going on. Bets were placed even on the elections. Some politicians and celebrities are also under investigation. It was found that around 1100 crore rupees from this scam was put into the stock market, especially into small and micro caps. Now 1100 crore rupees is a very small amount for large caps, but for small and micro caps it is a very big amount. It can easily move the prices of many SME stocks. Now this scam definitely caught SEBI's attention, and in addition to that, the small and mid cap stocks have become quite a bit overvalued. As a result, SEBI ordered this stress test for small and mid cap mutual funds. This test is basically a liquidity test, meaning how easily retail investors can redeem their mutual fund units and get their money back in case of a big correction. India's biggest small cap fund has published the results of the stress test. The Nippon India Small Cap Fund, which has assets under management of 46,000 crore rupees, would need 27 days to sell 50% of its stocks. The results for other major small cap funds were similar. Interestingly, the Nippon India Small Cap Fund stopped accepting lump sum investments back in July. Now this is a sign of too much capital flowing into the small caps. So here we have a little graph. The Nifty 50, which is the larger index in terms of market cap, has gone up 28% in the last 12 months. In comparison to that, the small cap 250 index is up 60% in the same period. This is more than double the return. You see, when returns are double, the corrections are also double. So here we have some data on the volatility of small caps and also a comparison of the returns of the small cap index versus the returns of the small cap mutual funds. The blues represent the index and the greens represent the mutual funds. As you can see, 2014 was a year of massive returns for small caps. The index gave 55% returns and mutual funds gave almost 90% returns. In the next 2 years, investors got very low returns. Then again 2017 was a very good year for small caps, but the next 2 years gave negative returns. Investors should be prepared for such inconsistency before getting into the small caps. So the HNI investors, the people who always show us their bright green sports cars and their bright orange sports cars. These people often buy stocks with borrowed money. They play the game of leverage and they move the stock prices a lot, especially the small and micro caps. And right now, the liquidity of funds available for borrowing has come down. It seems that a lot of the borrowed money that enters the stock market actually come from the NBFCs. You are probably familiar with the Paytm issue and how the Reserve Bank has got strict with the NBFCs. So now there is less buying due to scarcity of borrowed funds. Plus, due to the closing of the financial year on 31st March, there is profit booking and loss booking. Tax loss harvesting is a trick many investors like to use at this time of the year to reduce their income tax burden. So due to these reasons, we have more sell orders now and the stock prices are obviously coming down. The small caps, which are not fundamentally strong, may be in danger. But good stocks do not stay down for long. Here is the chart of a very good stock in my opinion, Action Construction Equipment. It corrected quite a bit from its high of 1500 rupees. But then in a single day, it recovered 18%. There are more than 5,000 SME stocks listed on the exchanges. and maybe only 100 to 150 of them are worth investing in. Picking the right stocks is extremely important in small cap investing. Along with that, investors also need the mindset to deal with volatility. A 50% correction in a small cap portfolio is no big deal. So this stress test move by the SEBI has been appreciated by many well-known fund managers. But the finance minister apparently does not like it. She feels that Indian markets are matured enough and market forces alone should be allowed to decide the prices. Now I cannot argue with that, but having a slowdown in the small caps for a while is better than the segment getting into a bubble and then crash. Investors also need to remember that the average returns of the large cap index over long periods is around 12%. In 2023, it was 20%. In 2021, it was 24.6%. Sooner or later, it is going to revert to the mean of 12%. So please be prepared for that. And lastly, there are two things which destroy wealth of retail investors. Number one, selling good stocks during a market correction. And number two, borrowing money to buy stocks during a bull market. And always remember, large companies make small moves and small companies make large moves. I'll see you soon. Jai Hind.